Hello everyone, I'm Dr. Stock, and in this video we are talking market today, CPI tomorrow, retail sales, PPI, consumer sentiment, survey of consumer sentiment from the University of Michigan, and then also what in the world is going to happen with the federal funds rate coming up next week. Are we going to see that rate increase or not? That's exactly what I want to talk about in this video. Do me a favor real quick before I get there. Do yourself a favor. Down in the description of this video, go ahead and pause it, find the link for Moomoo. Click on that link, sign up, and by depositing $100 or more, you get up to 17 free stocks using my link available through my channel. Here's how it works when you open up the account and make your deposit. If it's $100 or more, you get 7 free stocks. 2 of them are AI draws, the other 5 are valued up to $2,000, and then for $1,000 or more, you get 17 free stocks. Still the 2 AI draws plus 15 other free stocks, still valued up to $2,000. Take advantage of this offer. It doesn't last forever. It closes out in March, so get it while the getting's good. One other thing, while you're looking down in the description, find that link for the Patreon. If you want to hear more of my commentary, get access to my exclusive content, and participate in my private Discord, find that link for Patreon down in the description. We'd absolutely love to have you over there. That said, I'm Dr. Stock, Doctor of Education. Let's get right into the content. So here's the market today. The Fed came out and they decided that they were going to save the depositors from SVB, making sure that they made good on all their deposited funds. And that news, the market today, we actually had enough strength almost to make it up to that 200-day. As a matter of fact, I think a decent CPI tomorrow coming in core of 0.3% month over month. If we get that, I think that easily is enough upward pressure, assuming that we don't get more calamitous news about banks, regional banks for certain. And then if we have any bad news about big banks that get subject to it, well, then that wipes out everything that I have to say about inflation reports. So CPI, I think, has the potential tomorrow to give us enough upward pressure to bring us up about 1.5% from today's close in the S&P. So we're going to have to watch for that. Now, if it comes in 0.4, I think that kind of gives us a little bit of mixed results. And if we come in 0.5 is going to be absolutely rough. That would not be good for us because it puts the Fed in a tough spot. I'll get more to the federal funds rate and the potential hike that we have coming up in March in just a moment. But that is something that I do want to keep an eye on. I think that a hot read for the CPI tomorrow at 8:30 a.m., that's something that with all the other news that we have going on, that to me at 1.75% down or possibly even up to 2% down in the S&P. So I think that could be some very bad news for us. Matter of fact, I wouldn't be surprised if it waxed a little bit harder. I don't expect to have anything above consensus come in. I think 0.4 would be the worst case for month over month for core. I think 0.3% is much more likely this month. And I think that would be absolutely excellent because it would take some of the pressure off the Fed that they could say that January was a one-off and that February is much more normalized to what we saw coming down all the way from the peak in October, down to November, down to December, January, seasonal adjustment, and then sort of normalizing once again, settling a little bit for February. That would ease some of the pressure that's on the Fed. So that's what I expect. And so I think we either get a mixed day tomorrow because core came in at 0.4 and the market does what it does, or we get 0.3. I don't think it'll be better, but that would be really surprising. We came in below 0.3. The post-pandemic average is 0.4% month over month for core CPI. And so 0.3 would be, in my opinion, a really positive thing, possibly put us back up to that 200-day simple moving average. Let's take a quick look at the Qs. There we are. So on the Qs, we actually closed up above the 200-day simple moving average. Awfully good for us. And we have just a little bit of a golden cross going on. We'll have to see if this is the right market environment for it to make good on that golden cross. This is something that could be largely overlooked given the current sell-off that we've been in and with the bank FUD like we had. And we'll have to see with the Fed if they are going to pause. That could certainly influence what we have. If the Fed does pause, the NASDAQ does stand a chance to rally, in my opinion, better than what we would see in the S&P, that we could actually have a much stronger run up. So we're going to have to see if it has that sort of sensitivity. Now, tomorrow, a good CPI read could possibly put 2% on the board for us, coming in at 0.3% month over month for core. I think it has enough upward pressure to do that. That's putting aside, let's say that some of the fear that's in the market right now of bank collapse subsides a little bit, or at least we don't really kind of go status quo on us. That could be something. Or if we get improving conditions, that certainly helps that case of making that 2% bump in the NASDAQ according to what we have here in the Qs. All right, so I just wanted to toss this out there that Goldman Sachs analysts no longer expect Fed rate hike in March after SVB failure. That's something that I've discussed on my channel before prior to this coming out. As a matter of fact, it was after monetary policy when the Fed said that they still have yet to see the full impact of their tightening, and now we have some banks collapsing. So hopefully this is them seeing some of that impact, that unintended consequence, and going, you know what, we've been pretty aggressive, let's hold here for a little bit. That could most definitely happen. I said that they needed time, and well, time is playing out. Hopefully this is bad news in time and just I know it's serious bad news, but it could be worse. It could be complete bank collapse. That would be much, much worse. We see some regional banks go over. While that's very bad news for us, it could be a slap on the wrist compared to consequences of like massive recession, for example, because they did over tighten, they didn't give it enough time, they were too aggressive, and now everyone's stuck paying the price because of it. Here's an analyst coming out from Altimeters that says the SVB crisis shows the Fed needs to slow down or a lot more stuff is going to break. And if we go towards the end of this, it says that what we see with the 10-year treasuries happening and what's going on with the SVB, the fact that there are things going under, it says that's the market telling the Fed, you better slow down, otherwise a lot more stuff is going to break. We're going to have a massive recession and much bigger problems. All right, so here on the CME Fedwatch tool, check this out. 38% chance of no rate hike, 62% chance of 25 basis point hike, and that 38% is significant because just on the last trading day, just on Friday, there was a 0% chance, according to this tool, for having that 0% hike, no rate hike whatsoever after the next FOMC meeting, which takes place on March 21st and March 22nd. There was a 40% chance of 50 basis points. That got wiped off the table today, saying 0% chance of getting that 50 basis point hike. And I think, honestly, the only thing holding on to 25 basis points are the inflation reports, retail sales. I think those are the three things that we need to watch coming up. So that's Tuesday at 8:30 for CPI. That's in the morning. And then retail sales and PPI both come out. We want to watch those numbers, CPI 0.4% month over month or lower. That's exactly what we want to see happen. When we look for PPI, we want to see that come in. It came in last month at 0.7. Right now, I believe the consensus is either 0.3 or 0.4% month over month. Meeting consensus is just fine. If it comes in a little bit cooler, that's even better. We do not want to see a beat on consensus. We definitely don't want to see a repeat of January. That's going to put the Fed in a bit of a bind from where they're at right now. Now, if they had to choose between inflation or bank collapse, they would choose a little bit more inflation. That's just my take on it, but I think it seems like a pretty cut and dry choice. Now we go to May, we can see a 50% chance of being between 475 and 500. We go to June and we are actually at 450 to 475. So they actually think a little bit lower in June. Go out to July just to see how it's changing. 425 to 450. So they're actually seeing it declining, at least according to the CME Fedwatch tool, down to 4.4 to 4.25% in September. Let's keep moving and see how far this thing goes. The most likely choice they have pausing in November. Let's see December. By December, they're actually saying between 3.75% and 4% for the Fed funds rate. So that is wildly different because that was over 5% just like last week. That was absolutely incredible to see. As a matter of fact, we can check that out down here. So one day prior, looking at December, as of March 10th is what we'd have. Okay, so this was 4.75 to 500, so we're a full percent off. So if you want to know just how serious this situation is and how serious the market believes that it is and what it's going to do to the Fed's decision that they can't afford to be as aggressive as they thought they were, I mean, we can see it happening in the Fedwatch tool and the statistics that they have on there, that they believe that there's going to be pausing and there's actually going to be some pivoting that also takes place where they start reducing the federal funds rate throughout 2023, which previously, even up to, I don't know, I think it was like a week ago, maybe 2 weeks ago, there was maybe a 25 basis point reduction at the end of 2023. And now we're back under 4% potentially, according to what we have right now in the markets. So we're absolutely going to have to watch what inflation does. Tomorrow, 8:30 is going to be enormous. Retail sales is going to be pretty big. It came in 3% for January. It's expected to be negative for February. I think 0.1 to 0.3, negative 0.1 to negative 0.3. And then PPI, like I said, 0.3 to 0.4% month over month for that one. We want to watch those numbers. They are going to be absolutely critical. They will be crucial to impacting the federal funds rate. And I think they're also going to tell us a lot. I think they take a lot of the pressure off the Fed if they come in cooler like I expect and cooler like some of the consensus says that's out there. So let me summarize. Tomorrow, I think the CPI could possibly be that thing that allows the markets to lift up a little bit, assuming that we don't get further pressure from the banks. We're going to have to watch and see. Remember that there's any number of variables that go into the market, but I think the CPI coming in at 0.3 month over month for core, which is where I expect it to be, and that's beating consensus. That is something that could push the markets upward from there. If it does come in at consensus, it's not going to be the worst thing. I don't think it confuses the Fed. I don't think it adds extra pressure to have it come in 0.4% month over month. It is higher than we want, of course. However, they did say that they already expect higher for longer. It's going above 0.4% for core month over month CPI. That's where we start to get into a little bit of the trouble zone that would kind of force the Fed in some way to at least further consider still doing a rate hike in March, despite what we're seeing going on with the smaller regional banks. PPI, retail sales, also watch those as well. Wednesday, 8:30 a.m. And I'm going to be covering these on my channel because I think that they're very important to watch. I think they have high impacts to the market. And then following those reports, then it's time to start talking once again about the summary of economic projections. I put out what I thought the Fed was going to do prior to this whole SVB thing. And now I got to change my opinion on a few things. So I'll rework that once I see the inflation reports, and then I'll put out what I think the Fed is going to do moving forward with their policy when that comes out, with their summary of economic projections, when that comes out following their meeting on March the 22nd. So if you like my commentary and you'd like to hear more, find that link down in the description for the Patreon. Click it, sign up, and get access to my Patreon exclusive content and be a member of my Discord community. Also, while you're looking down in the description, get that link for Moomoo. Sign up, deposit your money, get your free stocks. It's a wonderful opportunity for you, and it helps to support the things that I do here. And last but not least, don't forget about that like button, hit that subscribe button, and ring that notification bell to see any time that my videos come out. I am Dr. Stock, Doctor of Education. We'll see you in the next video.